honestly think that looking at the financial flows dollar is not so important. That's what everyone looks at, the dollar index. But if you look at, let's say, the dollar's representation as a share of global forex reserves, we just hit the lowest level in 29 years recently. So on that basis, you're talking about, the difference between a financial flows measure of the dollar and a real world transaction in the dollar, where around the globe, it's just representing less and less in terms of the total share of reserves out there. And ultimately, people will say all that matters is the financial flows, because that's massive trillions upon trillions of dollars that are being traded every single day. And that's what maintains the dollar reserve standing. But ultimately, I think we're really chipping away at that as well. And that's what the BRICS plus countries are all about. They're trying to set up a vehicle, a market, and a system by which they can create an alternative to the whole dollar, the financial structure. And it's not going to happen overnight, but they're making tremendous progress toward it. And toward that goal, they're gathering up gold reserves to make whatever currency debut, or even if they don't have a specific currency, but they just have a reference to gold for the block themselves, it would create a real sense of a hard money currency that they're transacting in, as opposed to the dollar, which is obviously just sheets of paper that, with 36 trillion in debt that needs to be financed and no one out there buying it, will require running the printing presses over time. It's interesting to me, however, that their first shot was to talk about a crypto reserve. And, maybe that was a stop to pick up voters. And now they feel obligated to follow through because they did campaign on that as something they were going to do. So, but, as to gold, I guess the only issue might be that if they were to come out and publicly say, we're really going to start to add gold to the US gold reserve, and we're going to be more aggressive and, protecting our gold industry and this and that, and maybe, limiting the exports of that, etc., it might be viewed as betraying a concern about the dollar's reserve standing. I'm just suggesting that maybe, in the back of their mind, they think It's an acknowledgement that we have a problem and we're trying to address it. The economy and the consumer especially have been struggling, but the markets have almost capriciously ignored it. When you look at the situation in the economy versus what's going on in the markets, it's a tale of Main Street versus Wall Street. And you've had consumer sentiment that's been in recession territory, while the stock market cap to GDP has been hitting all-time record highs. So, this, I think, is just an example of how the market's just been absolutely priced for perfection. And I have to assume that this empty space here is justified by the expectation that the Fed is going to cut rates, to solve this problem. And, the current inflation backdrop suggests nothing of the kind. The other thing that I thought was interesting is over the last couple weeks, we've seen a massive rally in the long end of the Treasury curve. And I thought this was interesting because last week in particular, I wanted to see how much of the short position, which has been substantial, was covered. I think it was about 3,000 contracts. The point here is that there's a lot of room for specs who are currently betting on higher rates on the 10-year to cover those positions as they concede to the reality that the economy is slowing rapidly. So this is juice for a further rally in the 10-year bond yield. My sense is that the rally in the 10-year will ultimately find a floor much higher than prior economic downturns by virtue of the fact that we have this recessionary deficit situation before we even go into technical recession. I went back and looked at when we deflated the dot-com bubble and had the recession associated with that. And then again, when we had the global financial crisis, both times you had a massive mushrooming, not surprisingly, of the deficit relative to GDP. So in 99-2000, when the dot-com bubble burst, we were actually running a surplus of 2% to GDP and a budget surplus of 2% to GDP. And that very quickly switched to a 3% deficit almost overnight. In the global financial crisis, we went into it with a deficit that was minus 1% of GDP. And that promptly went to minus 10% of GDP. Our starting point today, if you believe, the most flattering numbers, is minus 7%. That's our starting point. So if we have any kind of significant slowdown in the economy, or heaven forbid, a repricing of risk that's significant, you could see that go easily to, 15% of GDP. I mean, we're talking about massive numbers here. And then how low do treasury yields go in that environment? The only way that they can go down would be for the Fed to come in there and buy every treasury that's issued, in which case, again, the dollar becomes the veil for our sins, to the benefit, one presumes, of gold. I think it's a trade, for the reason I just cited, with that spec position and a lot of shorts that need to be covered. And I presume they will be covered in the process of discounting this recession. You could get a run in the 10-year that brings yields clearly back below 4, 3.5, something like that, perhaps. And then at that point, I'd say that's enough. I'm going to now move entirely into the front end of the curve and just hunker down there. There's enough uncertainty, especially when we talk about the inflationary setup. If you got a situation where this time, even though it didn't work out that way in the first Trump administration, some of the tariffs actually do feed through to the CPI, then you're talking about an environment where that decline in the 10-year would be limited. But I do think we'll see a meaningful move in the 10-year, maybe 50, 60 basis points. So if you feel like you want to take advantage of that and you're a good trader and you are willing to position that, go for it. I don't really have the bandwidth to do that. I'd much prefer to just sit here at the front end of the curve, collect my 4%, and not be a hero, because I feel like gold is paying me enough between gold and the gold miners, which I think now we're reaching the point where you want to start to move from gold. You had to get a movement in the bullion that was substantial enough to persuade people to touch the miners, because the miners are legendarily horribly run and they just can't seem to get anything right. But they are trading at levels that are so absurdly cheap relative to the bullion that even a monkey should be able to make money, running a gold miner. So I'm still holding bullion, but at the margin, I'm adding more and more the miners. Walmart relative performance has been a bellwether of mine for a long time. It is a classic economic bellwether. So when Walmart is outperforming, generally the economy is slowing and possibly going into recession. And when it begins to underperform, you've probably reached the bottom in the economy and things are starting to improve, because people now can, become more aspirational. So that completely underscores the point you were making as relates to the action last week for Walmart. It was a one day, their earnings number came out, the stock got hit, and it went right back to outperforming the S&P again. People are now acknowledging that things are difficult enough for consumers out there that they have become Walmart shoppers. And even Walmart is seeing that it's starting to hit across the constituents. And I worry about the high end, particularly as relates to my expectation that we're going to see the markets finally revert to some more normal valuations, because that top 20%, that's where all their confidence comes from anyway. The wealth effect is being driven by them. And if not actually spending the dividends that they're getting on their stocks, at least psychologically, they're spending the dividends that they're earning on their stocks. So another barometer that I like to look that relates to that is if you look at, let's say, the Wilshire 5000, take the broadest stock index out there and overlay it with the quits rate, the job quits rate from the JOLTS report. Normally what you see is that stocks and the quits rate move together. As stocks go up, people are more emboldened to quit their job because the economy's good and they feel like they can go out and get another higher paying job. We have seen in the last several quarters, the quits rate absolutely collapse in the face of higher equity prices. So clearly there's insecurity out there. Again, the markets are not acknowledging. And I think that gap is going to be resolved by the markets coming down, not by the economy miraculously going up. The surprise to me has been that oil has stayed where it has even after Trump was elected, because he campaigned on drill, baby, drill, and ending the war in the Ukraine. And you would have thought that the markets would have anticipated that starting November 5th. And you just haven't seen it. And it's doubly surprising given the collapse in economic activity that we are seeing. So, if it hasn't gone down heretofore, I have to imagine that there are other things, namely lack of supply, that are keeping it where it is. You'd need to hire an oil analyst to give you real insight on that. But the demand situation is clearly fraying, and yet prices aren't coming down. I don't think that it's that people imagine this Ukraine imbroglio is going to last forever. But, you also still have Israel, and then talk about how that ceasefire may not be holding. So there's plenty of unrest around the world. It makes me not inclined to be bearish on energy. I am bullish commodities in general, and gold and oil in particular, just because they're strategic resources. But in broad generalities, I prefer hard assets to paper, especially right now. So I would be overweight basically a basket of commodities if you wanted to be long, let's say the CRB relative to the S&P. But within the commodity basket, I definitely would emphasize gold and oil. And then I'd probably be a little reluctant to be aggressive about things like copper, where it's such a function of global growth and housing in particular. Well, I have to believe that the deal will get signed. And I think it's very interesting that the administration is now sort of taking a page from China's playbook, and they're getting into sort of a Belt and Road type of approach. And thank goodness, because we've been sleeping during this entire period where China's been basically procuring strategic resources all around the globe. Wow. So the Ukraine thing seemed like a no-brainer. I think conversations around Greenland and stuff like that will continue to percolate. But as relates to the markets, it's just another example of the uncertainty and the volatility that you would expect the markets would begin to react to. And maybe they are. Maybe we're finally starting to see an acknowledgement that it's not going to be, even if we're moving in the right direction, it's not going to be smooth sailing. So we're going to have to buckle up a little bit.